You are not going to believe how many foreclosures there are in Canada right now. Mortgage debt just hit record high. At the same time, home prices in some cities are down 20 to 40% from the peak. Housing startups surged 1 month and then collapsed the next. Inflation spiked again just when everybody thought it was done. And meanwhile, Canada is more leveraged to real estate than at any other single point in human history. So Canada's housing market right now, it's definitely not normal. It's weird, it's fragile, and it's extremely interest rate sensitive. Plus, buyer sentiment is absolutely terrible right now. And that's one of the main factors that drives the market. So in this video, we're going to be breaking down why record mortgage debt actually matters, what's really happening with prices in construction, whether we're heading for a relief or a breaking point, and what you should do if you're buying, renewing, or investing in 2026. Let's dive in. All right, let's take a look at the big picture. Right now in Canada, nearly 3/4 of all household debt is tied to mortgages, not credit cards, not car loans that we usually see. It's all in housing. Total household debt in Canada is around $3.1 trillion, and about $2.33 trillion of that is in mortgages. That means roughly 75% of every dollar Canadians owe is tied to real estate. That's a record high. A decade ago, that number was closer to 67%. So when you hear headlines like mortgage debt hits record high as prices fall, that's not clickbait, that's facts. That's the system flashing warning lights at us because mortgages aren't flexible debt. You can't cut back on your mortgage like you can cut back on restaurants or travel or any other fluctuating expenses you have month over month. And then when rates move, the entire economy feels it. And in a country where housing drives construction, banking, retail, and GDP, if housing sneezes, the whole economy catches a cold. So what's actually happening with prices? This is where people get confused. National averages look fine. Prices are down maybe 1 to 3% year over year for the last few years, but sales are flat. This sounds boring, but averages hide pain. Under the surface, markets like Hamilton and parts of GTA are way off their 2022 peaks. We're talking some areas down 20 to 30% in real terms. And on the flip side, more affordable regions like parts of the prairies in Atlantic Canada have held up much better. So prices are falling isn't a universal story, but what we're really seeing is overheated high leverage markets correcting while affordable supply balance markets are stabilizing. Ladner and Tsawwassen, we are definitely in a buyer's market. We have anywhere from 10 months to 2 years of inventory based on certain price segments and style of property. And so this is exactly what happens when money stops being free. Like the cost of living is skyrocketing. The average income somebody makes in comparison to what it costs to live now is just the gap is bigger than ever. It's brutal out there. Let's talk about housing starts. They surge, then they stall. Governments keep saying we need to double down on housing starts. And the Carney government's $13 billion Build Canada Homes program, I can't say I shouldn't say what I really feel about that. I feel like it's the same sentiment that a lot of people in Canada have. And for a moment, it kind of looked like it was happening. We were seeing a lot of new construction happening, but that didn't really pan out. In September, housing starts jumped 14%, huge headline. Then October hit and starts fell 17% the very next month. So that's not a boom, that's volatility. Builders are dealing with higher construction costs than ever, tighter financing, and slowing down of pre-sales in expensive cities has been a huge factor in our market here. So yes, starts do exist on paper, but shovels we're not really even seeing that much. So what about Vancouver's mass rezoning? Vancouver just pushed through one of the largest rezonings we've seen in years. Thousands of lots, the Broadway Plan, the Cambie Corridor. On paper, it's big. With more density allowed by default, faster approvals, less red tape, that's all good. But here's the reality. Land is still expensive, financing is still tight, rents are softening in high supply pockets, and there are already tens of thousands of approved units that still haven't been built because the math just doesn't work. Zoning isn't housing. You don't live in a bylaw. You live in a building somebody could actually afford to build. Here's why record mortgage debt matters. Let's come back to the debt. Total household debt, $3.13 trillion. Mortgage debt, $2.33 trillion. That's 74.5% of all household debt tied up in mortgages, the highest ever. The danger isn't just high debt either. The danger is concentration. Almost all of Canada's debt is tied to one asset class that reacts violently to interest rates. Even after rate cuts, we're not in a zero rate land anymore like during the pandemic, and the renewals are painful for most. Variable borrows got squeezed, especially when we saw rate increase after increase. And then even when we saw 7 decreases in a row, it didn't really move the needle in terms of the market here. So many households are house rich and cash poor, which absolutely sucks. And sticky inflation. So groceries are up, rents are balancing out, some are rising, some are falling dramatically, core inflation still elevated, and the Bank of Canada is boxed in, and we don't really predict any rate cuts coming in 2026. So cut too fast, inflation and housing reignite, hold too long, households break, and that's what we're in right now. So are we near a breaking point? Here's what I'm watching. First, delinquencies. Still low, but rising from the extreme lows, especially in Ontario and BC. Second, forced sellers. Most people are hanging on by a thread, but unemployment plus painful renewals changes that fast. Third, inventory versus sales. When listings rise and sales stall, prices follow with a lag. So every single new sale is setting the new benchmark in that building or in that neighborhood for the next sale, and prices just keep on coming down. Fourth, policy wildcards. New agencies, new programs, big promises, no delivery. But supply takes years to work through, and it's not going to be fueled by press releases of positive things. So yes, Canada is fragile right now. It's not collapsing, but it's fragile. So what should you do? Let's make this practical. If you're renewing soon, know your renewal date now. Start looking at options. What's going to best fit your lifestyle? If you're in a super low fixed rate, you should probably start making double up payments on that to get familiar with what your payment is going to look like in the future once you have to renew. If you're barely scraping by, this is not the time to add debt or stretch. Please, we need to stop over leveraging our lives. Stability beats upgrades. Trust me. If you're a first-time buyer, don't buy assuming there's going to be appreciation. You need to ask yourself, am I okay if this is worth 10% less in the next couple of years? And I've always recommended to my clients to think of real estate as a 5 to 10 year play, nothing shorter. So focus on comfort, not your max approval. Think in a 10-year timeline. And if buying wipes out your emergency fund, waiting is not failure. If you're an investor, be brutally honest. If the deal only works with perfect rent growth and falling rates, that's complete speculation at this point, and it's something that I don't think is going to happen. So in this market, I want boring. Cash flow, stable jobs, resilient financing, people buying properties that make sense for them and their budget. So is this a breaking point or not? Here's my take. Debt concentration is flashing yellow. Some markets already corrected hard. Construction is very volatile right now, and it's going to continue to be that way for the next year or two. I don't think there's going to be a lot of new construction starts. Inflation is sticky. Households are exposed with our interest rates. We're at an inflection point. If jobs holds and rates stay stable, we grind sideways. If unemployment spikes or inflation forces rates higher again, then yes, things could break quickly. So my final thoughts and the key takeaway is don't panic, don't FOMO, don't YOLO. Buy like risk exists. I expect the market to decline steadily over the next 12 to 18 months. So prioritize time horizon, cash flow, and balance sheet strength. Work within your budget. Don't go to your max approval. You don't need to. Because in Canada, whether we like it or not, our financial lives are now deeply tied to housing policy and interest rates. So if this helped, hit like and subscribe, comment below. Do you think Canada grinds sideways or hits a real breaking point? I'm Chancey with Real Broker. Thank you so much for watching. I'll see you on the next one. Peace.